Gold is approaching a major liquidity zone where smart money is preparing the very next move. Today, my primary focus is a potential sell setup targeting key sell-side liquidity near 43.27. But there is one critical condition that must happen first before we even think about clicking a button.
We've seen a sustained macro expansion all the way up to the 44.50 level, but that bullish run has hit a brick wall. A clear market structure shift has occurred. The daily price action is now locked in an internal retracement phase, and institutions are seeking discount liquidity. They are actively preparing to pull price aggressively lower. My bias remains strictly bearish, and our primary sell zone sits right around 43.68 to 43.75. Notice this completed bullish leg into premium on the 4-hour structure, followed by aggressive displacement lower. We're currently sitting in the mid to upper portion of this 4-hour range, perfectly positioned for further downside delivery. But timing is literally everything.
So where is smart money actually positioned right now? Well, most retail traders are looking at the exact wrong level. They see minor support holding in the Asian session, and they're aggressively buying, thinking this macro uptrend is resuming. But this is exactly where most traders get trapped. Let me show you where institutions are actually targeting and how we plan to trade it.
Before we unpack the granular details, here is today's exact trading blueprint, zero fluff. Our directional bias is firmly bearish. The primary sell entry zone is between 43.68 and 43.75. Our main sell side liquidity target rests cleanly at 43.27.35. And our strict invalidation level, the exact point where this entire institutional narrative breaks down, is 43.98. If you understand these parameters, you already have an edge over 90% of the market today.
Now let's unpack the why. When we compare the macro daily distribution to the 15-minute execution time frame, it reveals the true institutional footprint. Smart money accumulated during the deep discount move in June and July, ran price aggressively into the August premium, and is now actively distributing. The narrative is heavily bearish continuation. We're hunting for a specific structural shift on that 15-minute chart that aligns perfectly with this daily distribution phase.
But the market doesn't just move in a vacuum. It requires a catalyst. These upcoming events aren't just news, they are the exact liquidity injections smart money needs to aggressively reprice the market. We have British pound CPI data at 1 p.m., followed by ECB President Lagarde speaking at 2:10 p.m. Overlaid on this is the ongoing US-Iran naval standoff in the Straits of Hormuz, injecting massive volatility into safe haven assets like gold. Institutions use these exact high-impact windows to sweep stops and initiate true displacement.
This liquidity pool changes everything. Look closely at the 1-hour order flow. We're seeing a clear failure to reclaim equilibrium. Price pushed into the premium side of the dealing range and immediately found institutional selling pressure. The buy-side liquidity above the recent 1-hour candles has already been partially engaged, which means the magnetic pull is now entirely to the downside. There's a wide-open, unfilled 4-hour fair value gap resting below us between 42.90 and 43.20. That gap is the magnet.
But here's the problem. The market is sending a warning signal right now. My strict advice to you is to wait. There is absolutely no valid institutional confirmation just yet. The trap hasn't been sprung. If you execute a short position right now, you're just guessing. And worse, you're acting as liquidity for the institutions. We have to exercise flawless discipline and wait for the algorithm to show its hand.
To remove all emotion from this trade, we're going to follow a rigid mechanical sequence. First, we need to see price expand higher into our premium fair value gap zone between 43.68 and 43.75 to sweep internal buy-side liquidity. Second, we must see aggressive displacement lower, a strong, energetic bearish candle. Third, this displacement has to cause a market structure shift on the 15-minute chart, breaking recent swing support. And finally, step 4, we enter only on the retest of the newly created 15-minute bearish fair value gap. If this exact sequence doesn't print, there is no trade.
Once that confirmation triggers, these are your rigid execution parameters. You sell within the 43.68 to 43.75 zone. Your hard stop loss goes above the structural lower high at 43.84.50. We scale out logically. Take profit 1 is at 43.45 to capture internal liquidity release and secure the position. Take profit 2 is our primary session sweep down at 43.27.5. And above all, utilize strict risk management, a maximum risk of 1% of your equity.
Let's contrast how the masses are viewing this versus how we are.
The retail view right now involves prematurely buying early Asian support. They see price holding and assume the bottom is in. But the institutional view, we know smart money is engineering a London Judas swing. This is a classic false move designed to trap early money. They're manufacturing a false breakout higher into that 4370 fair value gap specifically to trigger retail buy stops and accumulate short positions at a premium before aggressively repricing lower.
And this 15-minute structure illustrates exactly where that trap will be set. The consolidation and relative equal highs resting just above current price are exactly where smart money will likely create that false breakout. They'll drive price into that 4370 zone during the London kill zone or overlapping the high-impact news window, sweep those eager buyers right into the market, and then aggressively expand lower toward our true underlying target.
Let's lock this in with a final recap. Our bias remains firmly bearish based on the macro distribution. Your job as an institutional trader is to wait patiently for the 4368 to 4375 entry condition to trigger. Our primary draw on liquidity is 4327.50. And remember, if price closes on the hourly above 43.98, this setup is entirely invalidated. Protect your capital, wait for the sweep, and trade the institutional footprint.
If you rely on institutional-style market analysis using strict ICT concepts to navigate these markets, make sure you subscribe to ICT Market Theory. We strip away the noise and focus purely on algorithmic delivery. If you're looking to execute alongside these exact setups with precision, you can find the FXTM account link in the pinned comment below. But before you open your charts, ask yourself, in today's session, are you patiently waiting for the institutional footprint, or are you about to become the liquidity? Think about that until our next explainer. Stay disciplined.